even within the lenders, you can also talk about private banks versus PSUs, right? Because some of the PSUs are sub 15p still.
Correct.
And if you look at the private sector banks, like there is margin compression happening. Like you were talking about profit pools shifting to capital markets, which is a very real thing, and that is actually, a great second order insight, because not many people are acknowledging that that's where the money is moving from one place and one pocket to the other, right? But dive into that a little bit more, private sector versus PSUs, because that supposedly, HDFC, ICICI, darlings of the FII holding.
They are not done.
Now, they are seemingly
in fact, to be fair, it has been learning for us also, because we grew up in a phase where the competitive intensity within the lender space was tilted in favor of private sector banks always. They had capital, they had better execution, and they had no balance sheet challenges throughout last decade, which was the main point of basically problem for PSUs. I think today when you look at it, at least for last 2-3 years, why generally initially PSU banks outperform is because they were coming out of a credit cost cycle. Market always rewards relative earnings growth in near term, and in long term it always rewards capital efficiency and scalability.
Yeah.
So of course in near term the earnings growth for large part of PSU basket, not only PSUs, in fact even the two corporate lenders from private sector also were part of the same bucket, which is ICICI and Axis. So all of them actually had a superior earnings growth because their problems were getting over, so credit cost was significantly falling. So you not only had the tailwind of general, which the rest of the guys had, you also had basically your problems significantly reducing and thus your credit cost reducing, so your profit growth was superior. So your ROEs came back. So of course that part was rewarded more. Fast forward today, I would say I would be relatively more constructive on private sector banks versus PSU, for a simple reason that one of the thing which is a core challenge in the sector and which is what we indirectly touched upon, that the profit pools and liability side is moving towards some of the capital marketplace or some of the other avenues because of low return on investment on this side for retail investors. The liabilities was a larger challenge for private sector guys because they were already running at LDRs, which is loan to deposit ratio. Effectively, you can, in a layman term, you can say liquidity. How are you positioned in terms of liquidity on liability side versus what you are lending?
Yeah.
Private sector was already staged because they were running credit growth higher than their liabilities, whereas PSUs theoretically, because of the past challenges, because of their structure, were always lower credit to deposit or loan to deposit ratio. So last 2 years, they still had room where liabilities was the biggest challenge. Like what I said, liabilities was a challenge and somebody did not need it so much, whereas the private sector banks were struggling on that. So they had to slow down the growth, whereas PSUs could accelerate the growth. That phase has passed. Now these guys, on these parameters also, most of them are now at the similar level. And incrementally, thus the differential in the earnings tilting towards one side, PSUs versus private, I think is going to diminish as the quarters pass. And that's where more constructive view on private sector versus PSUs from next 1-2 years perspective, because the liability challenge that these guys face for last 2 years, the same problem now these guys will also face because they have exhausted their leeway in terms of incremental fast growth through the lower LDR that they were running. It's a little technical, but that's where basically also NIM pressure was more on the private sector banks versus the PSUs, and which will also reverse if the inflation remains a little higher and interest rate are not going to get cut incrementally. And that's the way we are looking at it.
True. I think, that's very reassuring to hear because one of the most frequently asked questions that I think is on the audience's mind is that, most mutual funds, wherever your SIPs are going, most of these funds have a huge exposure to private sector banks, right? And some of them almost 8-10% or 10-15% of their holdings, which, people are always worried that why are my fund managers still holding on to these companies when, they are consistently underperforming. So I think that's very reassuring to hear.
So I think one of the thing that I would want to highlight is that because the professional fund managers are also looking at risk along with the returns. And that's where while there is a near-term pressure, they're tilting towards holding something which has on an average 1.7 to 2% ROA versus something that has 1% ROA. We are in an environment which has been extremely volatile. Thankfully, and a lot of credit to RBI and basically banks also for that. Fortunately, despite all the events, there is no NPAs which has incrementally showed up in any part of the lending book except probably microfinance. But the moment that shows up, you know the difference when it hits a lender who has 1% ROA and a lender who has 2% ROA. The sensitivity of stock prices would be significantly different. And that's where, when that phase of credit cost benefits are over, that's where people are tilting towards this. So they also understand ki when the credit cost comes in, how it can hit these two buckets. And that's where those larger holdings, although they are in near term, giving a lot of pain, including to us.
It's true, but I think it's an industry-wide problem, not
Yeah.
just you.